Dubai has aggressively positioned itself as a global hub for the future. This ambition extends deeply into the burgeoning world of cryptocurrency. The city rolled out the red carpet for blockchain technology and digital assets. It aimed to attract innovators and entrepreneurs from around the globe. The promise was a forward-thinking regulatory environment. This environment would foster growth in the nascent crypto industry. For a time, this strategy seemed to be a resounding success. Investment flowed in, and companies flocked to the emirate, eager to be part of this new financial frontier. The city's skyline, a testament to its rapid development, seemed to mirror the meteoric rise of digital currencies themselves. The allure of Dubai was potent for crypto enthusiasts and investors alike. The city projected an image of modernity, wealth, and technological advancement. This made it an attractive base for operations. Many saw it as a place where the old rules of finance were being rewritten. They believed fortunes could be made quickly in this new digital gold rush. The government actively promoted its vision of a crypto-friendly ecosystem. This attracted a diverse crowd from serious technologists to speculative investors. The promise of high returns, often amplified by social media, drew in capital from across the world. Everyone wanted a piece of the action. However, this rapid expansion and the often opaque nature of cryptocurrency created a shadow. Beneath the gleaming surface of innovation, a darker current began to flow. The same factors that made Dubai attractive to legitimate businesses also appealed to those with less scrupulous intentions. The global, decentralized nature of crypto, combined with a regulatory framework still playing catch-up, inadvertently created openings. Scammers saw an opportunity to exploit the hype and the complexity surrounding digital assets. They recognized that many investors, driven by the fear of missing out, might not conduct thorough due diligence. The promise of quick, astronomical profits often blinded them to the underlying risks. This environment became a fertile ground for sophisticated deception. Fraudsters leveraged Dubai's glamorous image and its perceived embrace of cutting-edge finance. They used this to lend an air of legitimacy to their often dubious schemes. The city's reputation for luxury and success was co-opted to build trust with unsuspecting investors globally. These investors often viewed a Dubai connection as a mark of credibility. As billions of dollars poured into the crypto space, a significant portion was siphoned off by elaborate scams. These operations were often designed to look like legitimate investment opportunities. The full scale of this problem is only now beginning to be understood, revealing a troubling underbelly to Dubai's crypto dream. One of the most significant alleged scams to surface from this environment is Hyperverse. Co-founded by an Australian citizen named Sam Lee, who had been residing and operating in Dubai for several years, Hyperverse presented itself as a groundbreaking metaverse and cryptocurrency investment platform. It promised investors extraordinarily high returns, sometimes as much as 1% per day. These returns were supposedly generated through cutting-edge blockchain-based strategies and investments in various digital assets. The marketing was slick, and the vision sold was one of a decentralized financial utopia where everyone could prosper. Lee became a prominent figure, almost a guru within this ecosystem. The U.S. Department of Justice, DOJ, and the Securities and Exchange Commission, SEC, painted a starkly different picture. Near the beginning of 2024, U.S. authorities unsealed charges against Sam Lee in absentia. He was accused of conspiracy to commit securities fraud and wire fraud. The allegations stated he orchestrated a massive cryptocurrency scam that defrauded investors of nearly $2 billion. According to U.S. officials, Hyperverse was not an innovative tech venture. Instead, they asserted it was an old-fashioned Ponzi scheme, dressed up in the complex jargon of the crypto world. The promised returns were not from legitimate investments, but from the funds of newer investors. Despite the serious charges, Sam Lee, in an interview conducted in Dubai during a scorching July day in 2024, and reported by Bloomberg Businessweek on December 5, 2024, denied any wrongdoing. He claimed that any misuse of Hyperverse funds must have been perpetrated by someone else. He offered the simple explanation that startups fail, attempting to normalize the collapse of the multi-billion-dollar enterprise. Furthermore, Lee boldly stated that U.S. authorities have no evidence, so I don't have to do anything. This defiance was issued from Dubai, where he continued to live. U.S. officials have indicated they are working with their counterparts in the United Arab Emirates, UAE, to serve Lee with a summons. The Hyperverse saga highlights how easily a veneer of legitimacy can be crafted in the often unregulated spaces of the crypto world. The platform used sophisticated marketing, celebrity endorsements, and grand pronouncements about changing the future of finance. It tapped into the genuine excitement surrounding blockchain technology and the metaverse. This made it difficult for many ordinary investors to distinguish between a genuine opportunity and a carefully constructed trap. The alleged nearly $2 billion lost by investors underscores the devastating potential of such schemes. It also raises questions about the oversight in jurisdictions that attract such operations. The case continues to unfold with a correction to the Bloomberg article noted on April 8, 2025, indicating ongoing developments. The core mechanism behind Hyperverse, as alleged by U.S. authorities, was that of a classic Ponzi scheme. In such a structure, money from new investors is used to pay purported returns to earlier investors. This creates an illusion of a profitable enterprise. However, there is little to no actual legitimate business activity generating these returns. The scheme relies on a continuous inflow of new capital to sustain the payouts. Once the recruitment of new investors slows down or when a large number of investors attempt to withdraw their funds, the entire structure collapses. This leaves the vast majority of participants with significant losses. Hyperverse allegedly perfected this model on a massive scale. Hyperverse was particularly successful in luring investors due to its aggressive and sophisticated marketing tactics. It leveraged social media platforms, online influencers, and elaborate promotional events. These events often took place in glamorous locations, further enhancing the image of success and exclusivity. The scheme created a powerful sense of FOMO, the fear of missing out. Potential investors saw others apparently reaping huge rewards and felt compelled to join. Testimonials, often from early participants who were indeed receiving payments from newer investors' money, added to the perceived legitimacy. The global reach of the internet allowed the scheme to attract victims from all corners of the world. A significant factor in the success of scams like Hyperverse is the inherent complexity of cryptocurrency and blockchain technology. Many investors, attracted by the promise of high returns, do not fully understand the underlying technology or the business models they are investing in. Scammers exploit this knowledge gap. They use technical jargon and vague promises of cutting-edge strategies to overwhelm and impress potential victims. The allure of passive income, where money seemingly grows without effort, is a powerful motivator. Hyperverse capitalized on this desire, promising daily returns that seemed too good to be true, and for many, they were. The promise of financial freedom was a powerful bait. The impact on investors has been devastating. Individuals from various walks of life, enticed by the prospect of quick wealth, poured their savings into Hyperverse. Many lost life-altering sums of money. Some lost retirement funds, education savings, or money borrowed from friends and family. Beyond the financial ruin, the emotional toll is immense. Victims often experience feelings of shame, anger, and betrayal. The trust they placed in the platform, and often in the people who introduced them to it, was shattered. The global nature of the scam means that countless lives across numerous countries have been adversely affected by this single alleged fraudulent enterprise. The fallout from high-profile cases like Hyperverse has cast a long shadow over Dubai's burgeoning crypto scene. While the city aims to be a leader in financial technology, these massive alleged scams have undoubtedly damaged its reputation. International regulators and investors are now looking at Dubai with increased scrutiny. The ease with which such large-scale operations could apparently take root and defraud billions has raised serious questions. There is a growing understanding that unchecked ambition in the crypto space can lead to significant vulnerabilities. The glossy image of a safe and innovative financial hub has been tarnished by these revelations of widespread deception. In response to these challenges, authorities in the UAE, including Dubai, have begun to take more concrete steps to tighten regulations. The establishment of the Virtual Assets Regulatory Authority, VARA, in Dubai, was a significant move. VARA is tasked with creating a comprehensive legal framework for virtual assets. This includes licensing requirements, anti-money laundering, AML protocols, and investor protection measures. However, regulating the fast-evolving and borderless world of cryptocurrency is an immense challenge. Scammers are often agile and adapt quickly to new rules. The effectiveness of these new regulatory bodies is still being tested. They face the difficult task of fostering innovation while preventing illicit activities. Addressing crypto crime effectively requires robust international cooperation. Scams like Hyperverse often involve perpetrators, victims, and assets spread across multiple jurisdictions. This makes investigation and prosecution incredibly complex. Extradition treaties, mutual legal assistance agreements, and real-time information sharing between countries are crucial. The case of Sam Lee, who remains in Dubai despite charges in the US, highlights the difficulties in bringing alleged perpetrators to justice when they operate across borders. Without stronger global coordination, fraudsters will continue to exploit jurisdictional loopholes to evade accountability. This is a critical area that needs urgent attention from governments worldwide. Ultimately, while regulation is essential, investor education and due diligence remain paramount. Individuals must be empowered with the knowledge to identify red flags. Promises of guaranteed high returns, pressure to invest quickly, and opaque business models should all be treated with extreme caution. The adage, "if it sounds too good to be true, it probably is," holds particular relevance in the crypto space. Dubai, and indeed the global financial community, faces an ongoing cat-and-mouse game. As regulators strive to create a safer environment, scammers will devise new methods of deception. Vigilance, skepticism, and a commitment to transparency are the best defenses against the allure of digital mirages.